Hello, guys. My name is Joseph Ejike Oji, and today I'm going to keep you company again. The topic of our discussion is weighted average cost of capital. That means how to calculate the weighted average cost of capital. We have done this before, but sometimes the question might be asked in a different way. Sometimes in a more complicated way, which will necessitate us solving it using a different approach. So the one we did before in this class is we do use a method that is a little bit different from that. So I remember that the weighted average cost of capital, which I gave the acronym WACC, simply means the cost the company would incur to raise each new or marginal dollar capital. So for this, for the type of problem I'll be solving tonight on this, we'll be using this formula here. The formula is explained as follows: weighted average cost of capital equals the target weight of long-term debt times the cost of long-term debt times 1 minus tax rates. Okay. Then the target weight of short-term debt times the cost of short-term debt times 1 minus tax rates, plus the weight of preferred stock times cost of preferred stock, plus weight of common stocks times the cost of common stocks. So now these are the symbols that were used for them. WD for target weight of long-term debt, Wstd for target weight of short-term debt, WPS for the target weight of preferred stock, WS for the target weight for common stock. I can continue to that. T represent the marginal tax rates. Okay. Then RD, the before tax cost of long-term debt. rstd, before tax cost of short-term debt. RPS is the cost of preferred stock, and RS is the cost of common stock. Now, there are some things that we need to know before we begin the calculations. First thing is that the percentage of each capital component, which we call weight here, should be based on the marginal, based on the management's target capital structure. Not on the, that means it is not based on the particular sources of financing in a single year. Second thing is that the target weight should be based on the market, on the market values and not on the stock values. Then last but not the least is that the weight can be historical, can be target, or it can be marginal. At this point, I think we are ready for work, having given you this short and clear background. Look at this question here. It says, Oluwa Importers balance sheet shows $300 million in debt, $50 million in preferred stock, and $250 million in total common equity. Oluwa Importers tax rate is 40%. The RD, which represents the before tax cost of long-term debt, is 6%. And RPS, which as written here, RPS, which represents the cost of preferred stock, is 5.8%. And RS, which is the cost of common equity, is 12%. Now, if Oluwa Importers has a target capital structure of 30% debt, 5% preferred stock, and 65% common stock, what is its weighted average cost of capital? I want you to notice here that they didn't mention short-term debt. which means that the Oluwa importers have no short-term debts. So I want you to have that in mind as we do this calculation. So the first thing we do is to get our inputs, put them in Excel so that we can simplify the calculations there. So those inputs that I just mentioned, we'll have them listed here. See, the weight of target weight of long-term debt is 30%, and you can see that from here. You see that the if Oluwa importers has a target capital structure of 30% debt, so it didn't say short or long. That means we assume that it is the long-term debt, 30%. Now, next one is the cost of long-term debt, which will represent by ROD, the before tax. The before tax cost of long-term debt is 6%, which we see in the equations. ROD is 6%. Okay. Then for the short-term debt, there's nothing. There's no short-term debt, so we put 0 for short-term debt since there's none. Then for the weight of weight of preferred stock, WPS, is 5%. As this, so it is said here that 5% of the stock are preferred stock, see? And the weight of the common stock is 65%. As you can see here, for common stock, WS is 65%. Now, cost of preferred stock is RPS is 5.8%, which they mentioned here. RPS is 5.8%. So all these inputs, we put them in the Excel. So I'm going to show you, put them in. Let me write them down, and then I will put them in. I'll start with the WD. Okay, so I can just go back and forth. WD is 0.3%. I mean, it's 30%. That's 0.3 in decimal form. And ROD is 6%. Okay. Wstd for short-term debt, there's no short-term debt, so it's going to be 0. And rstd is 0 as well. We have weight of preferred stock is 5%. WPS is 5%. And we got that RPS is 5.8%. That is the cost of preferred stock. RPS is 5.8%. Okay. Then WS, weight of common stock, WS, which is, I said, weight WS is the weight of target weight of common stock is 65%. And then RS, cost of common stock, 12%. Okay. Then, of course, we know that the marginal tax rate is 40%. T is 40%. So having gotten all this input, we can just go to Excel and put them in. Okay. We have target weight of long-term debt is 0.3, that's at 30%. Target weight of short-term debt, there is no short-term debt, so 0. Target weight of preferred stock. So we have that as 5%, 0.05. Yeah. Target weight of common stock is 65%. You got 0.65. Yeah. There's 1. Yeah, this is just a part of the formula 1. So we're gonna put 1 right here. Then marginal tax rate is 40%. That's 0.4. Before tax cost of long-term debt ROD is 6%, 0.06. Now we have the before tax cost of short-term debt 0, because there's no short-term debt. Cost of preferred stock RPS is 5.8%. That means 0.058. And then cost of common stock ROS is 12%. That means 0.12. So we have entered them. I mean, make sure you enter the correct numbers. Then we can now calculate the weighted average cost of capital using this formula here. You can see the formula right here. Hope you are ready for the work. So we're gonna put all of them the way it is put here. Remember, when you are working in Excel, doing work on Excel, to put equal sign first. That will tell the cell, that will put the cell in a ready mode for work, for calculations. So I'm going to put equal sign and use parentheses to group your work so that to make sure that it follows the order of operations. So I'm going to put parentheses. So the first thing I'm going to put is weight of the target weight for the long-term debt, which is 30%. I click on it, times the cost of long-term debt, which is RD. You can see right here, RD, 6%, times, okay, put 1 minus the tax rate. See 1 right here, minus the tax rate of 40%. See, 1 minus T. Then close it. Make sure that you close it to where so that it will be standing alone. Like this one is standing alone now. Then we're gonna put plus. Then another parenthesis, we have target weight of short-term debt, even though we don't have it, but to make this is a part of the formula, we just include it where there's no 0 times the cost of short-term debt, which is rstd, which is also 0, times you have 1 minus tax rate, 1 minus tax rate of 40%. Close it again twice to balance it. So you have 2 opening parentheses. Okay, I think I didn't put it here. Okay, I'm gonna correct this. So first of all, we got the target weight of short-term debt is 0. Okay, times cost of short-term debt is also 0, times with parentheses, then 1 minus the tax rate. Then close it twice so that we have 2 opening parentheses and 2 closing parentheses to balance it. So plus weight of preferred stock, you can see right here, weight of WPS, weight of preferred stock, which is right here, 5%. Okay, times cost of preferred stock, RPS, which is right here, close the parenthesis, then plus the last one, which is a weight of common stock, which is 5%. You can see WPS, 5%, times the cost of common stock, which is right here, cost of common equity, which is 21.2%. So now close it and then press the enter key to give us the cost. Okay, I must have missed something here. I will take average cost of capital. So let's see. I must have missed something up. Let me see where the mistake comes from. All right, let's see. Take it to the where I got my inputs to get the mistake corrected. I think RPS is 0.05, okay. Then 12%, 6% for this, okay. WPS is 0.05. Let me make sure everything. WPS 0.05%, okay. RPS is here. Okay, 5.8%. Okay, WS is 0.65. Then RS, which is the cost of common stock. Then tax is 0.4. Then 0.3. Okay, let me look at the calculation again, see what why my answer is so high. So 0.3. Okay, 0.65, 0.4. Okay. 0.2. Okay, I see it right here. Instead of writing 0.212, I wrote 0.21. Okay. RS is 0.12. So I'm gonna change it 0.12, 0.12, and that will correct our answer right here. See, it's corrected now. So I'm gonna highlight it. So the Now, our answer should be in percent, so I'm going to change it to percent. How do I do it? Two ways you can do this. Okay, two ways you can do this. You can right-click on it, right-click, choose Format Cells, and then choose a percentage. Okay, that's it right there. Click OK. 9.17%. Okay. So that is the weighted average cost of capital for the Oluwa Importers Incorporated. I think that's the name of the company, Oluwa Importers. So now, I hope you enjoy this part, because the question can be asked in a different form. Sometimes they won't give you all the information. You have to estimate some of them by yourself, then use it. I mean, put those in what your inputs into the formula. Sometimes you might even need to modify the formula, like the one we will do next. That one is here. Says, let me make sure you're seeing this. Okay, good. It says Brent Incorporated is evaluating its cost of capital. Under consultation, Brent Incorporated expects to issue new debt at par with a coupon rate of 7% and to issue new preferred stock with a $3 per share dividend at $22 per share. Excuse me. The common stock of Brent Incorporated is currently selling at $16 per share. Brent Incorporated expects to pay a dividend of $1.75 per share next year. An equity analyst foresees a growth in dividend at a rate of 3% a year. Brent Incorporated marginal tax rate is 39%. If Brent Incorporated raises capital using 40% debt, 9% preferred stock, and 51% common stock, what is Brent Incorporated's cost of capital? Again, they didn't mention short-term debt for some reason. I don't know. But usually you work with the information you are given. Okay. So to answer this question, answer it well, we need to calculate three things first, which are not given here. They give us an input that we can use to estimate them. Those three things are before tax cost of debt, cost of preferred stock, and cost of common stock. We need these three things. Then we can now combine it with the other inputs they gave us here to calculate the weighted average cost of capital. Let's start with the before tax cost of debt. The formula is RD 1 minus T. Now, where T is the marginal tax rate. Now, they told us that RD from the equation is say that Brent Incorporated expect to issue new debt at par with a coupon rate of 7%. So we can put that as our RD right here. So the tax rate, marginal tax rate for Brent is Brent Incorporated marginal tax rate is 39%. That's right there, 39%. So let's put this information into our Excel to calculate the before tax cost of debt. So our RD is 7%. Okay, let me see. Okay. See, gonna take you here. So RD is 7%, which is 0.07. And 1 is part of the formula, so I'm gonna put 1 here. And tax rate, what did they say to be the marginal tax rate? The marginal tax rate, like I said, is say it is 39%. I mean, it's 0.39. And when you put that as a decimal, 0.39, so I'm gonna take you there. 0.39 for the marginal tax rate. 0.39. So with that, we can compute our cost of debt, before tax cost of debt, using this formula here. See? So you have equals ROD, which is 7%, times, okay, in parentheses, 1 minus the tax rate. Close it, and then press the enter key. So it will give us the answer as a decimal, which we can change to percent by working the formulas. Math cells, choose percentage. Okay, to get 4.29%. Sorry, 4.27%. But to make sure that it doesn't mess up our calculations, we can change it back to decimal, so that we don't it doesn't mess up our calculations. So after we can now change it back to percent. So I'm going to leave it this way. It is here as decimal. So we have calculated the first item. Now next is the second item we need to calculate here, which is the cost of preferred stock, RPS. So the cost of preferred stock, to do that, we need DPS. See the formula right here. Okay, let me show you the formula where it is much clearer. See the formula right here. DPS, which is preferred dividends, divided by PPS, which is the preferred stock price, times 1 minus the flotation cost, F. Now, in this particular problem, there is no flotation cost, because this is not a new stock issue. This is not this is not an IPO, initial public offering. So really, they don't have a flotation cost. It doesn't mean that it must be an initial public offering in order to have a flotation cost. But this particular example they gave us, they didn't mention the flotation cost. So our F will be 0. So that means based on what we have, you say that DPS, you say that the Wdrd Incorporated, the Wdrd Incorporated expect to issue new debt at 7% coupon, and to issue new preferred stock. To issue new preferred stock at $3 per share dividend, okay, and also $22 per share. So they want to issue new preferred stock with a $3 per share dividend, but the price is $22 per share, which means we have to put preferred dividend of $3 first of all, and then the stock price of $22. So let's put them there here. $3 for the preferred dividend, and then preferred stock price of $22. Then of course 1 is part of the formula. We just put 1, and there is no flotation cost, put 0, so that the cost of preferred stock now becomes, you're gonna use this formula here. So you're gonna have it as equal DPS, which is preferred dividends, which is $3, divided by, I put parentheses. Oh, yes, I like to include parentheses to make sure that it follows order of operation. We have PPS, which is preferred stock price is $22 times, okay, 1 minus the flotation cost of 0, no costs. Okay, close it properly. Then I press the enter key. Again, it will give me the answer as a decimal, which I can change to percent by right-clicking on this and choosing format cells and choose percentage. See, that makes a percent. Now again, in order for this not to mess up our calculation, remember we are getting these three items so that we'll be able to calculate the weighted average cost of capital. So if I leave it like this, it might mess up our final answer because it is 13.64%. So we're going to change it back to decimal. When we finish all the calculation, we can now change, fix it. So I'm going to, again, I'm going to highlight it. Okay, now, last item is that we need to calculate before we actually do the computation of the weighted average cost of capital for this company is the cost of common stock, cost of common shares. So for that, we're going to use this RS equals D1 over PO plus G, where RS represents the required return on the market or the cost of common equity. So either we call it the required return on the market, or we can call it the cost of common equity. D1 is the first dividend a new stockholder expects to receive or will receive at the end of year one. PO is the actual price of stock today, and G is represent the expected growth rate in dividends as predicted by the marginal investor. So let's put from our information we have. We remember we have that it said that it will issue this company will issue a dividend of one. You see here it says Wdrd Incorporated expect to pay a dividend of $1.75 per share next year. See, and remember that the that same share is okay. 1 minute, and it also says here that the common stock Wdrd, the common stock of Wdrd Incorporated is currently selling at $16 per share, and it expects to issue a dividend of $1.75. So let's start with our factor into our input here. So we're gonna put it that D1 is $1.75. D1, which is the dividend, first dividend a new stockholder expects, which is $1.75. Okay, and then actual market price of the stock is $16. And then the expected growth rate in dividends. According to what we have, that for that company, the says growth rate says it says here that an equity analyst foresees a growth in dividends at a rate of 3% a year. So that means dividend growth rate, we are going to enter a 3% there. So I'm going to take you there. So 3% is 0.03 when you change it to decimal. So we're going to enter it here 0.03. Having have all the information now, we can now calculate the cost of common equity by looking at this equation right here. That will help us. See, first one is the D1. But before you do that, put equal sign, then D1, which is the first dividend of $1.75 divided by parentheses. Oh, sorry, you know what? I'm going to use parentheses for the beginning so that I'm going to be dividing these two together. Then after that, I'm going to add G. So $1.75 divided by $16, close the parentheses. Then you're going to plus the growth rate of 3%. Then after that, you press the enter key. So again, the answer is in decimal. We'll come and fix it after we finish. So now we have the 3 items we need for the calculation. Now we can now go and put them in here. But starting from the very beginning, from the other input they give us, it says here for this company, I'm going to go and copy this down, that the it says here that the okay, I have all the inputs right here. See, it says right here. It says WD represents the weighted target weight of long-term debt, WD. Okay, it says here that Wdrd Incorporated raises capital using 40% debt. So the target weight of long-term debt is 40%. So we can go there and put 40%, which is 0.4. Okay, 0.4. Oh, excuse me, 4. Then with this one is target weight of short-term debt. We don't have short-term debt, so we're gonna put 0 there. I mean, the company doesn't have a short-term debt. Weight of preferred stock. Weight of preferred stock. We can get it from what they told us about the capital structure of the company. 9% preferred stock, which would be 9.09, 0. Then the weight of common stock. We are also told there in the company's capital structure that 51% are common stock or consist of common stock. So we go back and put 51% here. I mean 0.51. Okay. Then before tax cost of long-term debt. Okay. Cost of long-term debt. We are told that let's go to the actual see the long-term debt. If you recall, a matter of fact, we have the calculation because they didn't give us the cost of long-term debt. That's one of the things that we calculated, if you remember, before tax cost of debt. Okay. So let's go and put it in. We have it here. We're going to put equal sign here and go and pick it up from where we have done the calculation. Before tax cost of long-term debts. Here. Click on it and press the enter key. It will enter right there automatically. Short-term debt. No short-term debt, so we can put 0. Cost of preferred stock. We just did the calculation. So we go there and pick it up. We put equal sign, go to cost of preferred stock. Click on it, press the enter key, it will insert it there. Then cost of common equity. Again, we did the calculations right here. Put equal sign, see, computing cost of common equity, we did that. Click on it, press enter key, and it will automatically insert it. So we have everything we need. Now, there's one small modification we need to make because in this question, we have already calculated, remember, we have already calculated before tax cost of debt. And to calculate it, we use 1 minus tax rate. See? So we have used the 1 minus tax rate already. So we will have to modify the formula a little bit because we can't use the 1 minus tax rate part again, so that we to avoid double count, using it to messing up our answer or our work. So we're gonna use a revised modified formula whereby in which the 1 minus tax rate part are removed. So leaving out with this. Okay, so this formula we're gonna use here. A weight of long-term debt times the cost of long-term debt, and so on and so forth. So let us go and then use that formula. I put it here so we can use it right here. As you can see right there. So let's do the work. Equals the weighted average cost of capital, again with parentheses, target weight of long-term debts times the before tax cost of long-term debts. See? Times before tax cost of long-term debts. Okay, close the parentheses. Okay, plus target weight cost of short-term debt is 0 times the target weight of custom debt. Target weight of short-term debt times the cost of short-term debt is also 0 because we don't have the short-term debt. Plus weight of preferred stock, which is this one here. Click on it. Times the cost of preferred stock, which is you can see right here, cost of preferred stock right here. Okay, close it. Plus weight of common stock is this one here, times cost of common stock. You can call it common stock or common equity. Okay, close the parentheses. Then now when you press the enter key, it will give you the answer. It will give you the weighted average cost of capital for this company. So I press the enter key, give me that. So I'm gonna change it to percent. Now, right click, format cell, choose percent. Okay. You can also get it from on the top here, where you can just click on the percent. So I'm going to highlight it. So I'm going to use a different color to highlight it. Maybe I can use light green, 10.4%. Now I can convert all these calculations to percent. Okay, format this, choose percentage. Okay, format this, right click on it, format it, choose percentage. Okay, then right click on this, format it, choose percentage. Okay, so you have all the answer we need. Then we have arrive at our final answer, and I have this also presented in my PowerPoint here, so you can see 10.4%, 10.04%. Okay, so now in our next, I hope you enjoyed my lecture. If you do, please subscribe to my channel so that we'll be notified each time I have a new lecture. In the next coming lectures, I will be taking a look at the cost of new common equity. One more time, thank you for listening, and then I'll see you in my next lecture. Good day for you.